Good morning, everybody. Welcome to the Flow Show. It's Friday at last. Morning, Kay.
Hey, good morning, Ryan. Good morning, everybody.
Oh, lost my screen now. What am I doing? There we are. Hope everyone's doing okay. Another mad day happening already. It's relentless, isn't it?
Yeah. Every day's got its little crises now these days, right?
Yeah, exactly. Well, lots to get through as usual. So let's kick things right off. We're going over to Japan, and Reuters ran a poll of Japanese firms, and they see global inflation and recession as major risks for the fiscal year 2023. 48% of firms expect dollar yen to trade in a range 131 to 135 in the new fiscal year. 82% see global inflation as the risk. 43% see Japan CPI at 2.1% or higher. I haven't seen what the other side is because these are all less than halfway for dollar yen and CPI. But anyway, 43% see CPI at 2.1% or higher. 85% of companies plan to maintain or increase capex, i.e. investment. So some stories coming out of there from Japan. Coming over to the ECB, and ECB's Centeno says inflation was and still is too high. He's a dove on the ECB, so that could be construed as hawkish comments. One of the arch hawks, Hawky Holtzman, says we will probably have to do more in May on rates. That might be seen as a little bit dovish coming from him about we will probably have to do more rather than we will need to do more. And then we've got ECB's Muller saying that we wouldn't worry about a financial crisis in Europe. Well, maybe he needs to have a look at the Deutsche Bank stock chart this morning, because that's telling us something completely different. And Deutsche Bank seem to be the next bank in the crosshairs. Credit Suisse is its partner in the which banks are in trouble stakes. They've already been taken over, and the market has quickly switched focus to the next weak link or weaker link, Deutsche Bank. This is driving a lot of what we're seeing in risk markets at the moment. Now, what Deutsche Bank did do, they announced a decision to redeem some bonds, some fixed rate bonds, and they're called subordinated tier 2 notes, which is probably way above a lot of people's pay grades as to what that actually means. This is along the similar lines of the AT1 bonds, i.e. this is institutional lending to banks and whatnot. And as a side, trying to show a sign of strength, they redeemed all these notes which were due 2028. So they've paid them off early, including all the interest due over that period. So they haven't asked for money, they've paid back debts. This is supposed to be a sign as showing a strong hand, if you like, that there's no problems, we've got plenty of money to prove that we're going to pay off a load of these notes. That hasn't worked. At the moment, it looks like they could have kept the money in the bank and done greater good with it, because they are getting hit at the moment. CDSs are blowing up, share prices going down. They are firmly in the market crosshairs at the moment. I don't see any justifiable reason why they are, unless there's some skeletons falling out of a cupboard somewhere that we don't know about. But that was a similar situation to Credit Suisse. And it's times like this where the market can force the hand of these banks and regulators. What are you making of it, Kay? Is this justified, or is this market playing more games and trying to push buttons?
Well, I mean, that for one is the new style of how the market is reacting, and more than I think panic surrounding Deutsche Bank. Well, it's been going on for years as well in Deutsche Bank, as we know. But why now? It's just, I mean, ripple effect, tsunami wave effect. People want to get out of everything. If you look at it in the markets, it's all like one gigantic trade. You're seeing yields collapse everywhere. You're seeing banking shares collapse everywhere. Yeah, for the time being, it's probably a short seller's paradise. But whether it's all justified or we wake up next week and we take a massive turn to the other side, it's all possible, because that is what this market does these days. But has to be said, as I said, it's all one big trade, and we've seen some data starting to weaken. Now there's this worries. People thinking that the recession has started. Then you will see those stocks getting hit across the board. And then I think also what happened yesterday is and it was like literally in the hundreds of millions, not even billions or whatever, but the ECB draw on the swap lines. There's been some permanent swap line drawn on the Fed. We saw Yellen have to retrace what she said during the Powell's press conference, that perhaps they will guarantee deposits, and the market just takes it as okay. I mean, something is really wrong here and now, and then they press really hard on risk, on yields. Yeah, I think it's all like one big pot right now, and we will see where we wake up afterwards.
Yeah, I mean, this is almost mirroring what happened with Credit Suisse. Gavin's just put it up, and I've just seen it on the screen as well. Head of the Bundesbank has come out and declined to comment on the Deutsche Bank share price slide. That is almost word for word what the S&B said when they were asked about Credit Suisse the other day when they started getting hit. So yeah, to me, this does smell like someone or someone's is going after banks at the moment, as they are wont to do. That's the nature of the market. We'll see whether they have a case here or whether they're biting off more than they can chew. Being heavily backed by Germany, one would maybe think that they will come up short-handed on this one. But as always, we don't know the unknowns and what might be lurking that people know about that we don't. Anyway, moving on. Yep.
I'm just reading those Nagel comments saying that he thinks it's normal that we're seeing moves in the market. There's often a bumpy road after similar instances in the banking sector, he says. So he's not that panicked by the looks of things. And he said that current interest rate level is not high in comparison to rates of inflation. He's not wrong there either, but the market seems to think that they will never get any higher than where we are now.
Yeah, exactly. Anyway, those Muller comments that you wouldn't worry about a financial crisis in Europe aren't aging well right this morning. Over to the S&B, and Jordan says, at present does not see a need for additional liquidity support from the central bank. Current instruments are very big. They are bold. We shall wait and see for that. Been a ton of data out as well. And let's start with yesterday's stuff. So just a quick look in the US. Jobless claims, nothing to note there. Running really fairly quiet, sticking around that sort of 190, 200 mark. So nothing really to see there. New home sales missed expectations, fell on the month until last month got revised. So it's actually up on last month. That's the way revisions work. All in all, we've had the main housing numbers for Feb this week, and they've all come out pretty good. So again, that data divergence showing its head there. Don't even need to look at this number, Eurozone consumer confidence. It has gone back to being my most favourite number after the Canadian ADP got stopped. It's been positive probably about 4 times its entire history. So a good indicator of absolutely nothing. Back to Japan, and CPI dropped back to 3%, 3.1% in the core, 3.3% in the headline. This was touted, if you remember, by, I think it was Kuroda last month, when we got that reading up, that big jump up to the 4% mark. So this is not wholly unexpected by the market, and makes you wonder how they knew that it was going to drop back so much, yet they can't predict what it's doing in 6 months' time. Anyway, no real reaction in the yen on that data there. Today, we've got all the PMIs coming out, an improvement in both markets or sectors in Japan, still in contraction in manufacturing, but an improvement. Services, modest improvement there. Coming over to the UK, retail sales looking okay for Feb, better than expected. Core sales as well, much higher than expected. So again, confounding some analysts and particularly UK press on how dire a situation it is here in the UK. Spain final GDP, they're coming in a touch weaker year on year, but matching the quarter on quarter numbers. And then again, this divergence in the sectors, France manufacturing coming in an improvement, but not beating expectations. Services up a good amount. They are 55.5 versus 52.5 expected. Germany, the same thing there. Manufacturing worse, but services better. The pan-European number reflecting that as well. And in the UK, similar situation as well, but services edging down a bit as well, manufacturing edging down a bit further there, but still in expansion. So, as I said, still got this bit of data divergence going on that we need to keep an eye on. Let's see if that continues into the US later today as well. We've got the PMIs coming out there as well. Canadian retail sales, durable goods, and that ends the data, I think. Yep, that ends the data from the US today anyway. So yesterday also we had the Bank of England hiking by 25 pips as expected. Also, as we expected here, the votes, which were expected to go 6-3 in favour of a hike, stayed at 7-2 as they were last month. So inflation data that we saw on Wednesday being reflected in those votes. The usual doves were on the other side, wanting rates to be left unchanged, Temrero and Dingra. In the statement, the BOE repeated that if there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. It wasn't a press conference meeting, it wasn't a monetary policy report meeting, so nothing there, but Bailey decided to go out and about doing the press rounds later on and this morning, and some of these comments, I'll let you make your choice about those. So yesterday he said, we have raised interest rates a lot already. We believe inflation will fall quite rapidly before the summer. Then he said, we don't know if 4.25% will be the peak in rates. He sees signs of inflation peaking, but it's still far too high. But there are signs of inflation pressures calming down. Well, not if Wednesday's data was believed. He's now been out in the press this morning, and those who may remember a few months ago, he came out and said that firms shouldn't raise wages, otherwise it brings inflation. Well, today he said that firms shouldn't raise prices, because if prices rise, inflation will rise and they'll have to hike more. And to quote, if all prices try to beat inflation, we will get higher inflation. Well, no shit, Sherlock, but you've got to ask the question, if people's input prices are going up, they're going to have to raise prices, because you can't expect businesses to run at a margin loss. So I'm not sure what his comments are there. He's supposed to be giving guidance to the country, but telling firms not to raise prices when their input prices are going up is just complete madness, if you ask me. It also shows why inflation becomes a problem, because it becomes entrenched. It becomes a vicious circle. input prices go up, your output prices go up, then other prices go up, and it's just a complete chain. And because of the nature of a lot of UK inflation, i.e. it's imported, rates do absolutely nothing about that. So it's why I constantly say that the BOE is largely helpless when it comes to trying to control inflation with rates. Not that that will stop them. I still think rates are going at 5%. I will say it until I'm blue in the face or until they start cutting rates. Kay, are we blaming the fall in the pound on Bailey today?
No, actually, yeah, I was looking at the sterling from the other side today. But yeah, I think regarding Bailey, you just made a big statement about yields. I'm going to make a statement about Bailey. The day he resigns, I'm buying sterling and I'm closing my eyes. It's no, it's just the way he brings over stuff. It's just not good enough, right?
Yeah.
And when I think about the Bank of England, I fully agree. They can't do anything about the imported inflation at all. But I think they could do much better by being much more hands-on. Instead of Bailey. Bailey is a dove, right? We know that he's always warning about the worst to come, but he can't handle the situation on a day-to-day basis, and that's the big worry for some of the sterling's how shall I say, credibility or strength. Yeah, for the rest, I don't have much to say on those moves right now. It's just risk, right?
Yeah.
People are the dollar's got barring versus yen and Swiss. The dollar's got its mechanical safe haven hat on since yesterday, and then the yen which lost its risk correlation for months on has regained it in 1.5 sessions as well, 2 sessions as well, when yields started to drop and the asset markets starting to feel bad. The yen came roaring back. Now again, as I've said, I don't know what's going to happen over the weekend. We can wake up on Monday and the whole storm has blown over and sky is clearing out, and then we take it all the other way around. But it's just looking at everything that's going on. We said that we are very data dependent, but this morning data and I mean economic data don't matter at all. We're just watching the banking stocks and trade from there. So I reckon it's a day to be very cautious with positions.
Yeah, I've got very little reason to be jumping in and out of this unless we get some really juicy levels. But we'll get into that in a moment. Just to finish off the headlines, as Kay mentioned earlier, there was headlines about the use of central banks using the USD swap facilities. The ECB used it for 483 million. The S&B used it for 107 million. But also last night there were headlines about the Fed's programs that they're running at the moment. The discount window loans was at 110 billion in the week to the March 22nd. It was previously 152 billion. I think those are weekly numbers that's being taken. And banks borrowed 53.7 billion from this new loan facility. Previously, they took just under 12 billion. And then the Fed have got loans to the FDIC bridge banks. That rose as well. To just under 180 million from 143 million previously. So it's there's a lot of movement going on between the central banks and between central banks and banks. And you know, one of our guys in the room, Five Magics, he's been on top of all this stuff. He says, you know, some of these numbers aren't as bad as they were last week, and that's 100% right. But I think it's what's happening at the moment is there's too much of these headlines going around, and sometimes it's just too many bricks in the wall, and the wall starts to wobble, and the wall starts falling down. The market doesn't care whether the amount was lower, higher, whatever than previously. it's worried that it's being used at all to such a degree. So, that's what's playing into these risk numbers. It just becomes a bit of a snowball effect. Whether someone's taking pot shots at Deutsche Bank, it doesn't matter. All these ingredients go in the pot, and then people sitting at trading desks or wherever look at it and think, are things looking good or are things looking bad? And if things are looking bad, well, they hit the sell button and take their money out of risk and put it into non-risk. It's a simple process. But then that said, Reuters had some sources out last night citing a memo saying that JP Morgan and Citigroup have told staff not to poach clients from banks under stress. I'm not sure if that
it's not
memo.
new.
Yeah, I'm not sure if that memo had a few smiley faces printed on at the end of it, because they're probably just doing exactly that at the moment. The vultures out circling and sharking everything they can get their hands on. Anyway, that's it from the headlines, unless you've got anything, Kay, that I've missed or you want to inject into things.
No, not really. But that CT and JP line is not new. They said it straight away after the SVB collapse. No, the only thing is on the Japanese CPI, but then it, as I said, it doesn't really matter. It came down, but it came down in line with what the Tokyo CPI already showed us last time. So I don't think it was a real surprise for the market. And the guy who said that he was expecting CPI to come down, besides Mr. Kuroda, was already the new
it was him, wasn't
Japan
it?
chief Ueda actually said it himself that he expected CPI to come down. So in that respect, I'm still of the belief he's not going to be the big reformer, but I haven't put on my butcher's gloves yet to catch anything in the end, because the market is a little too nervous and too panicky right now.
But again, looking at the yen and the Bank of Japan, have they yet again potentially going to be missing their window of opportunity to get rates up and to at least get out or start getting out of all this easy policy?
That's going to be the question of the next month and a half. I think it's end of April, right? The first Bank of Japan meeting under Ueda. So I guess they've got a month to prepare. But it'll all depend how this whole situation unfolds, whether it be in the States or in Europe now. If it's all like, all right, after one crisis, the skies will clear out again, then they will continue to have this window of opportunity. But if the rest of the world collapses around them, then they've missed it. But on the other hand, I think, and this is still my base case, I think Ueda, as I said, is not going to go all guns blazing. We abandon YCC, we put the rates at 1 or 1.5%. It's not going to go that way in Japan. And for the good and only reason that, well, if there would be another reason more important than this, it's possible, but there's one very good reason, and is that he's going to be in very close cooperation with the Japanese government, and I continue to repeat myself, they're putting stimulus package after stimulus package in place, and Bank of Japan will not make the Japanese government pay silly rates for their funding. Yeah,
no, agree with that. It's just it just seems if the markets are turning south, if economies are starting to turn south, which they're not. Look, well, as we've seen today, the data's are diverging a bit, but it's not really falling off a cliff. But if it does start tipping down, the reasons for the Bank of Japan coming out of easing just narrow and narrow. You talk about a soft landing for the US, they're trying to just come down to earth in a balloon, and it's just going to be tough for them. But as we say, there's plenty to happen over the coming months, and the Bank of Japan meeting is the end of April 28th.
Okay, yeah, that's.
So
and the thing is as well, Ryan, you were saying people sitting on their desk and they are looking at where's the needle, right? Is it bad or is it good? We also have to know that a lot of money management and call it and model funds and whatever, they're most of them handled by machines now. There's very little human involvement in some of the biggest. Even if you look at those even in the big ones, they're using a lot of algos that they program to react to certain situations, react to movements, and those machines they don't think when a situation is overbought or oversold. If they get an impulse to sell something, they will, and they will continue to do so until the system tells them to stop. And I think that really accelerated the past couple of years, and that is why also we're seeing those moves unfold. And I'm thinking about the yields market, for instance. Somebody who is watching the central banks and who is watching the economic data and whatever, would you be buying bonds when the US 10-year is just lost 70 BPs? Would you be buying 2-year when it just lost 50 BPs? I mean, I don't think so. The market makers of old, they would have said like, oh, hang on a bit, is this really realistic? But a machine doesn't think like that. It says, I need to buy more bonds, or I need to sell more assets. So here we go, and this is my basket. And that's why we always say like it's one big pot right now. And I think that is exactly what it is, because if you look at yesterday's move, for instance, there was absolutely zero reason for the EU and UK yields to drop as fast as the US, but yet they did, and because it's just one big pot right now, it's one big trade, and I think those models, they are just trading global baskets, and that's it, and it makes it very tough to somewhere know when a move is going to stop, or what is real. What is really realistic or not, makes
exactly.
it easy.
Yeah, and it that also translate. You're talking about bonds, that also translate, as all assets do. They all translate into other assets. What happens in bonds affects the yen, dollar, the same way as what happens in commodities affects different currencies. But there's always a moment. And I say this a lot, especially when you look at yield relationships. You take particularly US 10s and dollar yen. There's always a point where a yield move may drive the currency, but the currency will run into its own levels, where then it becomes divergent from the moving bonds. So, we've had a big, strong move in bonds. If they continue down another 25 pips, doesn't mean dollar yen is in effect going to keep going all the way down in that move. If dollar yen, well, let's say bond yields collapse and we get down to the 128s level in dollar yen, bond yields might still be going, but those who trade FX and those who have orders in FX and those who have stuff to do in FX might get down to 128s and say, well, that's where I've got to do some business, and then we see the move stop. So these correlations, they work, but if you're watching something like bond yields and dollar yen on an intraday basis, you've got to watch for those stretch points where the moves in yields don't carry on in the FX market, where FX market hits its own decent levels, and that's where you get a bit of a pause. Doesn't mean it's going to reverse, but you get a bit of a pause. So you can't. It's not linear, is what I'm trying to say. Don't just think because yields will keep going, dollar yen's going to keep going as well. There's always a point where it breaks. But yeah, as Kay said, it's volatile. It's been a really busy few weeks. I'm knackered today. It's been another busy week this week, so I'm not inclined to be jumping in all over the place. I got stopped out of the balance of my euro dollar longs from down in the 105s. I had my stop at 108.20 on the trailer. That got taken out, and now we're heading all the way back down again, maybe even going back in the 107 box. We've carved through the levels. We did try and hold up some of these levels on the way down. So this break at 107.60 held a support, had a minor hold there on the way down, but it's gone straight through. So the next level is going to be down at the 107 big figure, that point that we've had, or I've had this box at for a while. Again, where we close today is going to be important. If we close today down at below 107, that's going to make this whole move look like a short-term fake out. Even a faster one that we saw on the move to 110. Top side, the tech's confirmed up there. Again, this is why we have these levels on our charts, to know where the price might run into trouble and what happens after. So now this level up here, 109s, 2040s, 30s, whatever, that's your big solid area. That's going to potentially look like a decent double top up there in one way, shape or form. So, what can it do? Can it go all the way down to 105? Yep, of course it can. If these worries persist over Deutsche Bank, if some skeletons fall out the closet, then maybe we do get a move down to the 105s. Again, you've got to look at that and think, right, well, this is obviously a decent move if we go down there, 400 odd pips. What am I going to do down here? Do I trust that this news is really bad, or am I going to play the range? And I'll be looking to do exactly that. You don't need to put a lot of risk in down at this 105 area, probably from around 105.20. If you want to try the other side, try longs there, 20, 30 pip stop. If you're wrong, see what happens. But for now, if you're shorting up here, and there's people in the room who've been shorting up here, it's a great trade. Lovely pips to be made there, and finish your week off hopefully with some decent pips in the bank. But for me, it's where we're going to close. If we close above 107, nothing falls out of bed over the weekend, maybe that's somewhere for shorts to get out and longs to look at, maybe seeing if we're going to maybe start a new range, 107s, 109, something like that. Euro Swiss was another one I was long in on a little bit of where's it gone? On a little bit of a S&B fade. That's also got triggered on my trailer. I had that at break even, or my entry point rather. So again, I'm out of that, back to the drawing board. And it's reflective of the way you got to trade these markets at the moment. 1 minute you're going one way, the next minute it's all gone the other way. If you're trading, get in, take some money, lock in your risk as quick as possible, get your risk to zero as quick as possible, and then try and ride the trade for all you can. And but don't marry it. You can't stay one side in a market right now. Okay, what are you doing at the moment? Well, I know you're sort of not doing an awful lot, but
no, I did
pick a side, isn't it? In these moves.
Yeah, I did about the same, and perhaps I overlooked what Mark said in the room as well. Is that on the Swiss side, I was thinking we would see some outflows of Switzerland, but he's right in saying most of the foreign depositors are keeping their money in foreign currency. So I think, I overlooked that one, but it was okay. I played it a couple of times in and out on the Euro Swiss, and then I took yesterday already when risk was really starting to turn. I really scaled down to a strict minimum, and I took it out this morning as well. So I mean, in Euro Swiss, there's no harm done, but the rest of the currencies, I was long euro dollar. Also managed to sell some of it out on the way up, and then reloaded a bit. But then this morning through 108, I just let go. Small scar on the whole trade. But those are those things when you're wrong, you're wrong, and you just get out of it. If you're trading like we use, like slicing and dicing, it's never going to cost you much. But when you're wrong, just get out of it. So I did about the same on the Euros the overnight. I was up for those. Well, I was looking at those Australian PMIs, and it actually was a pretty sluggish number. And Euro was kind of stabilizing around 108.30 last night. So I went like, yeah, all right, let's try the Euro Aussie for a bit, and went long there. And then I just took it off this morning as well when the Euro dumped through 108. I don't know. I'm traveling extremely light today because, as I said, for the same reasons that it's all being sold right now, it can all get bought back. It is possible that the US comes in and adds another layer of panic to what we are seeing already right now.
Yeah.
So the dollar, barring versus yen and Swiss again, could see another bit of mechanical safe haven coming into it. But I'm not going to buy dollars right here, and I don't see any reason why, to be honest.
Yeah.
As I've said, the numbers are not really falling out of bed, but starting to show a little less buoyant. But then we're seeing the housing market pick up again. Yeah, so I think for me it's really a market of stay nimble, trade small. Don't be too proud to admit when you're wrong on a level or so, and yeah, just keep it nimble. And if the market turns around, there will be much more opportunities to get back into juicier positions for me at least.
Yeah, exactly. I mean, the funny one was dollar CAD yesterday afternoon. You know, this one's traded a lot in our room, and you know, it was down here breaking this 136.50 area, and I said, yeah, this looks like it's going. It's looking weak. The 136.50, it's getting chewed through more and more. We're seeing lower lows. It managed 20 pips. Now look, now we might be looking at trading up to 138s again, and maybe these highs. So you can't hold a view for more than 5 minutes in some of these markets. You know, but if you want to try your well defined areas, you know, you can do. So, you know, if you're looking at 138, this is a strong enough move. 138 may be an area where it runs into trouble. Doesn't mean it's going to go all the way back down, but you might get a few pips out of it. Or we have a look at these highs up here, and you have a look at those. But trading around in the middle here, unless you've got some really strong reasons to do so, for me, it's just okay. I'm not prepared to piss around in the middle. I'll look at these edges. If I like the look of them, I'll trade them. If I don't like the look of them, I'll leave them well alone, and we'll get on with it. Okay, do you want to cover some of the bits and bobs you've been looking at?
Oops. Yeah, sure, mate. And I was looking at, I was on the cat chart as well, right as you brought it up. So, you guys see my screen?
Yep.
Right. So this is what actually happened there. We broken through this horizontal and then the wedge, but we just held the 38.2, and then we started to go up. Yeah, a lot of people have been trading this pretty well in our room actually. Picking up here. Yeah, the risk was that it went below this 38.2, which is just held. So that's good one. And now we are already back above the wedge. And I know for a matter of fact that some people are long actually dollar cat. So that's well played. Nicely done there. Yeah, so the 137.40 is going to be 35.40 is going to be the first level here to watch. And then see what happens, as Ryan says, around 138 or those prior highs. I'm going to have a quick look at what happened in this euro dollar. So some other people were looking at different trend lines, but yeah, I need to clean my chart up a little bit. But if you look at those two lines here, those were the ones that I was looking at coming up into the 109s again. We have those prior highs and then those trend lines here. And I was lucky enough to take some off on the 78.6 and this trend line. And I was thinking Europe yesterday, if nothing really dramatic would have happened, which it did afterwards, but could have a look at the second one as well. But to me, the 108 figure 10 had to hold. This is where we stalled in this 108.30, and that was pretty funny because in Asia we stalled here the whole of the Asian session, and then Europe came in and went like, no thanks, not going to keep any euros for now, and just massacred it. So the first resistance, we had a little bit of here in the 107.75, then 107.60, I would argue, is a bit of a more important one. We had an acceleration again going down there. But the big resistance now will be 108 figure 10 again. It goes back above 108.10, confirm above 108.30. I think the dollar safe haven buys, or you can even hardly call it a safe haven. It's just a mechanical correlation, dollar buying, right? When the stocks collapse, people buying dollars. But it does not rhyme with what's happening in the dollar yields market, unless it's a flight into bonds and then you have to buy dollars again, yada yada. But it's always like a double-edged sword, that one. So yeah, we're on the next bit of a level here in the low 107s. But to me, where it really plays ball or not will be 106.75, 106.90 again. Couple of prior tops, and here we are close there to the low from where we took off. So those are the levels that I will be watching on the euro dollar. I'm just going to let New York walk in and see what they really want to do with it, because I've got no clue what the New Yorkers will do with this pair right here and now. There's a lot of cross trading going on as well, as we can see on the yen pairs. It's a bit Armageddon. Huh? We were trading back above this 143 zone for a little while, and then now we're trading like 350 points lower, and again challenging this support line. It's a little watered down already because we had tries below, but looking at the jumps we had off it, I still would keep an eye on what's happening at 139.5. We're not far away from it. For the close of the day. If it's below, there may be another difficult session for this pair coming up once Asia walks in on Monday. But if we start to hold and start to gradually move back higher, it may look a little bit better for risk. So keep an eye on what's happening at 139.5 on the close tonight, I say, and then those lows 138.80. And then we're talking about the big level around 137, mid 137s, if really the panic would hit the markets again this afternoon. On the dollar yen, we've broken through the support line. We tried it a couple of times, had some bounces off it, but finally the weight of the panic in the market is too big. Yields coming off is traditionally good for the yen, and they're helped by equity markets coming off as well, energy coming off as well. You just name it. It's all very, very positive for what's going on in the yen right now. But again, how much of this is panic and how much is real flows? And I leave that in the middle right now. So there's again another decent area of support around 129.5, 3/4. We went briefly into the zone, and that's holding for now. We're trading back above 130 as we are. But yeah, look at the close here. I think around this 130.40 above or below. If we're starting to ramp back above, then 131.25 should be a bit of a level, and then this trend line will come into play again, which is around 131.75, which is our yesterday bounce high before we started to go lower again. So I think that's going to be an interesting enough area to watch as well later on in the day, if we would get a rebound, which I really will leave in the middle right now. Cable. Everybody was looking at this wedge broken down. There was a bit of horizontal support as well. We had a mixed bag on the PMI, a bit weaker than the expectations may have been, but then we had a pretty decent beat on the retail sales. So I thought cable would have a bit of a chance this morning to hold this line. So with very small risk, I tried to buy it around here, and then left the ship when it broken through. But then I'm looking at this little level here around 122, the figure. We are turning around, and then we are seeing a bit of on the 4 hour, a bit of a MA action as well around here. But the main one for me right now, if you look at it, we were in this channel and we've broken up. It's going to be around 121 3/4 is it broke out. So people are probably gonna look at it. But to me, the most important one is here down around 121.40. Confirmation below 121.25 will really not be viewed as positive for this market. But as I said, I'm in doubt about the viability of this dollar rally, just based on the fact that the asset markets are lower and the banking the banking sector is going down. I'm a little in doubt about that. So I'm going to put on my butcher's glove and trying to catch a serious knife if it comes down here, I think. What else? People looking at the where is it? Yeah, the Aussie dollar. The Aussie dollar has broken out, but then failed to keep the rally yesterday, and we're back below there. As we know, Aussie is a risk currency as well, yeah. And so when risk is doing badly, Aussie falters. Keep an eye on what's going on around 66. If we get down there, we're not that far. We're trading at 30. Keep an eye on what's going on around 66.10. 65.90, because if that would be challenged, then I think there is a chance to go and test this 65.5.
Dare I say there's might be a head and shoulders in there? From the NOV deck.
Here?
Shoulder.
Here or shorter term?
No, from that NOV deck.
From where?
Shoulder on the November, December, where you had it first. Back.
Oh, this one, yeah? This one?
Yeah.
Yeah, but then we should re-challenge 68.75 first of all to see if we form the real second shoulder, right?
I can't believe I'm saying it, but
I still see it. I know. Back to school, Ryan. Back to school. No, but the one that broken was this one, and if you look at it, 71.5, 68.5. Let's say that's 3 big figures. That points to a possible move back down to where exactly we went. So I think this one has fully played out. Now we are trying to, and I'm not a wave analyst, but I think Gregor would be able to tell us what is this, like ABC, whatever, after the move being done. But I think it's important it holds here. Otherwise, it's really bad news for the Aussie, I would say. Looking at a bit of those, and the Kiwi is back to where it's risk on. No, I wouldn't call it risk on, risk off, but a measure of strength or weakness for the Kiwi. We're back around that 62, and should hold here, or bad news as well, right? So I think if no more bodies fall out of the cupboard, we always have to speak in conditional, right? If there's no more bodies falling out of the cupboard, I could see this one range a little bit. As I said, I don't really see too much fundamental reasons for the dollar to shoot up more than it's has already, but okay. So keep an eye on this. This is a pretty important level that's been identified a good number of times. If it gets below, then we could be heading back here to rather mid 61s or so before the week is over. Yeah, I just looked at the Aussie dollar SAB. I think it's we could draw a little bit of a line here as well. But then that's getting challenged right now, right? That's really getting challenged right now. I'd rather look at this one if you want to trade ahead of something 66.10, 65.90 or so. This little zone. Okay. EuroCAD to me, we've broken above this trend line here. You could also do it as a wedge. We've broken around above this trend line here, 147.25. That's where this one should be holding, or we may look at some people trying to make it look as a failure and get back down to 146 mids, where that big level was several times, and we had so many tries to get through it when it finally broke. So that's going to be a big measure point as well. But the first one should be 147.25. I'd say close above below 148 is already going to be, especially if it closes back above. I think then this up move remains very valid. I've got the impression that unless more bodies fall out of the European cupboard, there would be there's a case for this going to 150.5, based on what's happening in oil, where it found its resistance in oil as well, and if the American continent is feeling a little bit wobbly, but that's also conditional. Typical, this one should move higher again. I think there is a chance for this to trade into the 150s, but for that, as I said, 147.25, and more importantly, 146, 40.50 should hold. Okay, there's a couple of those emerging markets. I've been banging on about these low 18s in the dollar rand, and again, it showed up. Okay, again and again. You could put a trend line here, which held as well, but I mean, it's basically 18, the big figure, right? And everything up to 18.06 yesterday, a little try below, but then when the shit hits the fan in the market, typically emerging markets are not doing very well. So this is getting bigger and bigger, this 18 level. So if one day it breaks, be careful, because this could go really fast. Until then, really respect this low 18 level on the dollar rand. Okay, MEX has done the same with its 1840 zone. And I've said the 1840s to me is pretty important, and it's done and it's held as well. So now, similar to the rest of the EM sphere and what's happening on the American continent, I would say, keep an eye on this one. 1887, 1892 is the first real resistance zone for me. We're trading 18.75 right now, and then back up in those 19s, right? And then this is the really important zone, 1910, 1925, 30. This is a 1% range, but in emerging markets, things can go really fast. Keep this one, put it on a post-it. This is really important. And the underside, 1840. So if you want to have some interest in the MEX, those two levels to me are going to be decisive for what's happened next. Now, I'm pretty much done. China is also moving with risk. We're trying to get back into this triangle here. I've rebought my Euro China, but I think I'm going to let my dollar China bit go here. I'm not sure about the further development, especially that I'm not particularly dollar bullish myself. So, Ryan, anything else?
No, I was looking at that dollar China myself. It got quite close down to my potential buy area, down to that 680, 78 area.
Yeah.
On the dollar China. So I'm not comfortable leaving orders in overnight for that one, given how markets are at the moment. But I think if I catch it on the fly, that's the area I'll be looking at.
Okay, and we need to have a look at gold. And I know it's not very clear, but this one is 2002. It's the 127 extension of this move, and of this move that we had lower. It's 2002. There's a horizontal resistance. There's the peak, what we saw last time. So this is the last peak, which was around 2K as well, just shy of it. Watch out what's going there. If there's more panic in the house, this could really push through. But if the states walk in and we're starting to see a little shift around of what's going on now, and this could easily top out here again. So watch what happens in this, call it 2000, $2005 zone. I'm not taking a side of it right here. I think it's pretty much flip a coin around 2K for me right here. But yeah, just be prepared to see another failure if the situation quiets down. Okay. Similar to silver, although silver has been trading better than gold and is in a bit of a move higher again. We could be in this little channel or flag or whatever you may call it. Pattern. I never know how you guys call it, but keep an eye on. As I said, we're approaching this traffic zone between 23.35, 23.65. I keep a close eye on what's happening here because that's going to be the gateway to this big red line that we failed at 3 times on the last move up, right? And on the downside, well, it goes back down below 22.95, 22.85. Then we may be in a similar situation as gold and see some more correction in this one. I mean my long-term longs, I've let some go right around 23, just to see if there is a bit of a setback and I can get it back lower. But my base is still long there. And really that's it for me right now. I'm looking at the clock as well. Back to you.
Thank you, mate. Thanks, mate. I shall just take it back quickly. Because one thing I just want to share quickly, and can you see my screen okay?
Yeah,
cool. So there's a discussion I was having with one of the guys in our room, and I've mentioned this before. You know, if we've got volatile markets at the moment, then you'll do no better than to go into pairs that have less volatility, and something like that is euro sterling. And now this I can speak from experience because when I started trading on the life law, when I first went local, put up my own money, the pit I went into was the euro lira pit, which was an interest rate futures pit, which moved maybe 6 pips a day. Okay, 6 ticks a day. So it was a very low volatility trading environment. And you know, for me, who was the first time trading my own money, it was a wake up call. It was a bit of a training wheels pit. You know, the other side of the coin to the euro lira was the BTP pit, the Italian bond pit, which was absolutely bonkers. It would go 10 bid, 15 bid, 5 offered, 25 bid. It was mayhem. So the same thing for FX. And so if you're finding yourself getting chopped up in all this volatility, look at some of the other pairs that aren't as volatile, like euro sterling, because it can play nicely with the levels. Yeah, it's open to some volatile moves. We've got a 100 pip move the other day, but it can also play quite nicely with the tech levels, and you can have some patience, sit back, keep calm, wait for your levels, and you don't have to risk a lot. So that's just something for maybe some of you less experienced traders worried about the volatility. Take yourself out of it. If the sea's too choppy, go into dock or go and play in the paddling pool. Doesn't matter. Pips is pips wherever you make them. You don't have to be a hero making 300 pips in dollar yen when you can make 20 pips quite regularly in euro sterling. It's just about making the money, not how you do it. So on that note, I think we shall call it a day, call it a week. I hope you've had a good week. I hope what we're doing here is useful to your trading, the advice we give, the analysis we give. If it's not, or if you want to hear something else or learn something else, please let us know. We're all ears. We want to hear from you, and we don't hear enough from you. As always, big thank you to K-Man, Stel, and everyone for putting this show together around the back end. Please have a great weekend, a great rest of day. We shall see you all next week.
Have a good weekend, all.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.